The home buyer demand in 2025 in March has significantly declined. It's down 5.9%, the slowest pace for that month since 2009 when we had the crash, according to the Wall Street Journal. This collapse in demand is driving steep home price cuts, especially in Florida, which we've talked about before. KB Homes dropped prices by over $30,000 due to weak sales, and the slowdown is spreading to other states like Georgia, Colorado, Arizona, California, and Washington, with monthly home values declining and becoming more common. So this is, again, indicative of what we've been talking about, where the market is definitely slowing. And I'm going to go over auto sales as well. They say that analysts say a key reason for low demand isn't just high mortgage rates, but high home prices. People are still continuing to keep their prices higher than they should be. And in a recent survey, 72%, which is a high number, of potential buyers said prices were simply too high, far outpacing concerns over interest rates or economic uncertainty. Many sellers are reluctant to lower prices to match what buyers can afford. So they have these, I guess, delusions that their homes are still worth what they are, when in reality they're not, but they're keeping those prices as high as possible, which is sort of, holding off the inevitable. Many sellers are reluctant to lower the prices to match what buyers can afford, creating a bid-ask spread that stalls the market. Buyers often cap out at $350,000, while sellers ask for far more, keeping the homes unsold. And the affordability is at crisis levels at this point. Mortgage payments, I think this number is higher. They're saying mortgage payments now take up to 38% of median household income, the second worst in 72 years. I think that payments for housing is way higher than 38%. There are debt to income ratios that can go up to 45 and 48% on conventional loans. 38% seems kind of low to me. The worst in 72 years is definitely believable. Historical data shows that such extremes are unsustainable and typically lead to major price corrections, which I'm sure we're going to see. Home prices, when adjusted for inflation, are at all-time highs, exceeding even the 2006 bubble. There's a lot of reference back to 2006, 7, 8, and the where we had the housing crash in 9 and 10. Downside risk is substantial. Now, they do say there are some areas that are rising in the Midwest and Northeast due to inventory shortages, and Louisiana and North Dakota are the only exceptions for overvalued homes. In other words, most of the country is overvalued except for Louisiana and North Dakota. They'll end up catching up. It's just a matter of time. This was interesting. Las Vegas was overvalued by 60%, highlighting significant risk there. So that's pretty crazy, 60% in Vegas. And it reminds me a lot of what happened in 2008, 2009, and 10. So analysts are saying the housing market correction is still in its early stages, which I believe that it's true. A broader, deeper price decline are likely needed before demand recovers. And buyers are advised to wait, negotiate aggressively, and monitor affordability metrics before jumping into the market. And I agree with those analysts. You should definitely wait. These prices are eventually going to come down for sure. And the longer you wait, I think the better deal you're going to have. Now, the U.S. car market is also really struggling, and there's a huge oversupply right now. Car dealerships across America are facing a severe crisis in 2025. Too many vehicles and too few buyers. Inventory is piling up at major dealers like CarMax and AutoNation, with the average car now sitting on lots for 48 days, which is up from 31 days a year ago. This reflects a broader affordability crisis and declining consumer confidence, which we've heard before, declining consumer confidence. And I've heard that, I think it was GM, that still have cars that are back from 2021 that are still on their lots. So when I hear 48 days, again, I'm not so sure that 48 days is an accurate number. I think it may be a lot longer than that. So some of the key points here with analysts is consumer confidence is collapsing. April sentiment hitting its lowest since May 2020. This is again the car market. Many Americans are over leveraged with pandemic savings depleted and record high credit card debt, and student loan payments are coming back. I won't go into too much detail on that, but I'm sure you've heard stories that student loans are back in effect. So along with all the other debt, that's going to be a struggle. Auto loans are at 8%, which is extremely high. This is making financing unaffordable for a lot of people. And used car prices are down 9% year over year, but they're still too expensive for many people to buy. Now, as a result, dealers are slashing prices, especially on electric vehicles, because as we all know, many of these electric vehicles are not what they're all cracked up to be, and especially with what's going on with Tesla. And Jeeps is the other brand that analysts talked about where they're cutting prices there. Jeep is offering $18,000 off some of their automobiles, and they're getting financing offers with up to 25% off. And even though they're doing all this, the traffic still remains very light. So this is also another example of what we've been talking about is a recession. I think is already in place. It's just a matter of the snowball effect and how much worse it's going to get. Repossession rates are also rising, and this is reminiscent of the 2008 financial crisis. Once again, another thing going back to that financial crisis that was absolutely terrible. Consumer spending is shrinking, particularly discretionary categories like travel, cars, and real estate. And then we've heard about layoffs over at the technology companies, Intel, Tesla, and Microsoft, and even Macy's, the department store, are also laying people off. So this is a parallel to the housing market, and it suggests the car market is a leading indicator. Both sectors suffer from a mismatch between pricing and buyer affordability. So to me, that's indicative of a recession, or had at least headed into one, or the early signs of it, or the beginning of one. And as long as prices and financing costs remain high, both auto and housing markets are expected to decline further. So analysts say consumers are warned to be vigilant when financing cars, with deceptive dealership practices like hidden fees, mandatory financing, and inflated pricing tactics still common. Buyers should research fair market values, use loan calculators, and ask for truth in lending disclosures, and walk away from dishonest deals, if there's even people out there that can afford to buy a car at this point. So those are the two huge things for today. There's others that I will go over live tonight. Jobless claims, and McDonald's is also saying that there's a major problem with them. But let me know if you're noticing anything. Are you noticing cracks in the dam when it comes to people's finances and the slowdown in the market? And are you looking for a house, looking for a car? Do you think that interest rates and prices are still too high? Let me know in the comment section. Be sure to subscribe if it's your first time here. Click the like button, helps the algorithm. And also check out the description below where we have other links to other information such as our Substack and our official website and other things like that. Thanks for watching, and we'll see you in the next video.